Good morning, everybody. Welcome to this ETM Analytics and TreasuryONE webinar update on what's happening in the market space currently. I can imagine a lot of people's got a lot of comments out there about what's happening, the Trump trade, what's going to happen, all the headlines that's coming out since he's been inaugurated in the first week. He signed thousands of executive orders. Made good on his promises, sending back illegal immigrants. He's had a standoff over the weekend with Colombia. Had a little dig at Jerome Powell on interest rates that we'll see what happens this evening on the Federal Reserve side. Locally, I think land expropriation bill and what's happening there is topical at the moment. How emerging market currencies, especially the rands, behave up and down like a yo-yo. But to tackle all these issues and tell us a little bit more what's happening in the markets, I've got George Glenos here from ETM. Once again, it will present to us. Welcome, George. And then just if everybody's got questions on the right-hand side, just post your questions and we'll tackle them as we go. But yeah, for now, over to you, George.
Thank you, Vicard, and morning to everybody. Great to be with you all again. It's been one hell of a start to the year, I've got to say. And as fast as I can put these presentations together, that's how fast they're becoming obsolete, because there's so much change that's afoot at the moment. It's quite difficult to keep up with everything. And that goes both for the local as well as the international environment. So Vicard quite rightly pointed out that at the epicenter of a lot of things that's going on at the moment is Mr. Trump and his executive orders, his inauguration. He's ushered in a season of change, shall we put it that way? And that season of change is going to have consequences, some of them good, some of them bad. But Mr. Trump is known for his simplistic way of describing what he wants to do. And so what we decided is what would be useful is to have a look at some of the four main themes that he has campaigned on, and let's see if we can shed some light onto the topic, because a lot of these issues are not as simple as they seem. The more you start to look into them, the more you realize that this is a decision that shouldn't be taken lightly. That's probably got quite a lot of consequence as that will spring up off of it, and that it's a good idea to understand the nuance before just jumping in to the simplistic debate that sometimes makes its way into the public media space. So what we've done is we've come up with these four conundrums. Conundrum being, a question on an issue that needs to be resolved, and it's not abundantly obvious what the answer is. So they're difficult challenges to overcome, and I've listed four of them. So let's go through some of those, and I'll give you a sense of just what it is that we're talking about. So the first is the monetary policy conundrum. As you quite rightly pointed out, Vicard, Trump has put a little bit of pressure on the Fed. It's nothing new. He did that in his first term in office as well. He wants to see lower interest rates. He believes that the Federal Reserve controls interest rates, except that the market has proven to us more recently that that's not necessarily true. So the Federal Reserve, as you can see from this chart, has reduced its interest rates in the last few meetings. The first meeting by quite a big amount. They dropped it 50 basis points. Thereafter, another 225 basis point moves. There's a meeting today. We don't suspect that they're going to do very much today. They've done quite a lot already in a short space of time. But look at what's happened to bond yields. Bond yields in the US have moved in exactly the opposite direction. So just as the Fed started to cut interest rates, the bond yields started to rise. And that's a fairly significant development, because bond yields are the benchmark that is used to price most interest rate instruments in America. For example, if you were talking about your mortgage market, for example, your mortgage market benchmarks quite directly off the yield curve. So if your bond yields are rising, your mortgage rates are rising, even though the Fed has reduced interest rates. And that obviously has negative consequences for the economy and for the property sector. So simply putting pressure on the Fed to reduce interest rates isn't going to resolve the problem. What probably resolves the problem is focusing more squarely on fiscal risks, okay? And there what I mean is that the US has been running a colossal budget deficit for a long, long time. And what you've had is, because of that budget deficit, you've had levels of debt that have continuously risen through the course of time. And as a result of that rising debt level, you've had a risk premium that's baked into bonds. But over and above that, because of these colossal issuance, because of this colossal debt that has been amassed over time, the government is issuing a lot of bonds. So in other words, they are supplying a lot of bonds into the market, and that's excess supply is what's driving up yields. Now, the interesting thing here is that Trump wants to reduce taxes. Well, if you reduce taxes and you don't make that up in some form of tax revenue, then you just have an even worse situation that arises. So simply coming out here and saying we want lower interest rates and we want taxes to come down doesn't necessarily resolve his problem. In fact, it might make things worse. So that's his first dilemma.
Sorry, second dilemma. Quickly interrupt you. So with Jerome Powell coming out on interest rates tonight, the market doesn't expect that he's going to do anything. He's going to stay flat and watch. Is that all a contributing factor about this colossal non-farm payrolls number out of December, unemployment that's come down to 4.1%, this US exceptionalism that we've seen? Is that still all continues on from that the interest rates will stall in the US? Or are they worried about the inflation?
I think inflation is too elevated for the likes of the Fed. The Fed wants to see it closer to 2%. Inflation at the moment is just north of 3%. So they've got quite a long way to go to get to their inflation target. Core inflation is coming down, but ever so slowly and sluggishly. So they've got work to do. At the same time, you've got a labor market that's tight, and the unemployment rate sitting at 4.1%. That's hardly a loose labor market. And you've got US GDP that remains pretty robust at this point. So there really isn't any obvious need for them to loosen monetary policy aggressively at this stage. The US economy is performing reasonably well right now. We'll get to whether or not that's going to be sustainable in the future. But for now, it looks like the US economy is doing okay. So I think that's the reason why they can afford to pause for the time being and wait for the dust to settle. Hopefully inflation continues to come down, and if we do see GDP type risks emerging and the US economy doing less well, then they have got some room to reduce interest rates further and to stimulate some of that growth. But I see you've moved on to the second slide. So the second slide is about Trump's second conundrum, and that's about these geopolitical risks. So when he was looking to get elected, he promised that he would end these wars. And he has come out quite strongly trying to get the likes of Ukraine and Russia around the table. And I think he's having some success on that front. Equally, we've now got a ceasefire that's emerged in Israel. And that's all great. But as you can see from the accompanying chart that was updated as of yesterday, geopolitical risks remain somewhat elevated. So they're still there. So he hasn't as yet reduced those geopolitical risks. But even if he does, the consequences of that for America aren't necessarily positive. And why I say that is because, well, you hear about America providing aid. They term it aid to Ukraine and to Israel. But in fact, what it is a stimulus package for their own military sector, which then sends the munitions over to Ukraine to be blown up. So you reduce the requirement or that war has on for munitions, for example, and you reduce the demand for the sector that has been propped up in recent years almost because of these wars. So the military sector is one that could take a little bit of a knock, and at the margin that will impact some downstream industries. It's also likely to just shave off a little bit of GDP growth. So again, he has a second problem for him that's not necessarily easy to resolve. On the one hand, you want to end wars, and that's a good thing for the world. On the other hand, if doing so, you might just remove some of that stimulus that's been applied to the U.S. military machine in the past few months. The third conundrum, which is his stance on illegal immigration, is an interesting one. Now, he did campaign on the fact that the Biden administration had allowed a lot of illegal immigrants into the US, and it's very clear from the chart on the left that that was true. So Trump's first term, you can see what border crossings on the southern border looked like, and they were, well, somewhat elevated on the previous regime, but nothing like what happened during the Biden administration. So as Biden came in, all of a sudden, illegal immigration over that southern border just skyrocketed. And you see why it became such a hot campaign topic. Now, here's the thing. We've had some pretty decent growth coming out of the US in recent quarters. And at least in part, some of that dynamism has been created out of the fact that you've got a growing population, which generally leads to stronger demand. Now, you've also got a population that tends to serve the lower income job market, such as your migrant laborers that gets utilized with crops and the like. So you have these interesting dynamics that are at play with regards to these illegal immigrants. Now, I'm the first to admit that I don't want anything illegal. So I don't like having illegal immigrants in any country, and I think it's important for countries to look after their borders and to, at the very least, filter who gets to come in and has the privilege of living within your country or not. I think that's very, very important. At the same time, there is a growth consequence to that. So the chart on the right tends to reflect what we call demographic energy. On the bottom, we've simply calculated what we call useful life years in the current population. So we simply take life expectancy. Out of that life expectancy, we have a look at the amount of productive people within that population, and we calculate the amount of life years available. On the left-hand vertical axis, we look at the projected growth over the next 10 years of that population. A high demographic energy, a dynamic energy would have a very high projected growth rate over the next decade. America's, as it stands, is not particularly high. You can see it highlighted in that dot on the right. It does have high useful life years, but it doesn't have high projected growth over the next decade. And so clamping down on the migrants that are coming into America is only going to make this worse. So it's going to drive that blue dot down towards where Germany sits, and God forbid, as far down as Japan, although I don't think so. But you can see that the countries with the biggest demographic problem at the moment, being Germany, Japan, and China, are all sitting below America. And what they are trying to encourage is immigration, especially of the younger population. And if they can do that, they tend to restore their demographic energy. America doesn't sit with that problem quite to the same extent, but it might find itself working towards that problem if the clampdown on illegal immigrants is so hard and they do this mass deportation that it negatively influences both the useful life years in the current population as well as future growth rates.
George, sorry, we'll just go on then. There's a question here that's asking is there any risk that the data is manipulated to serve a particular narrative or agenda? I assume that border crossings, because I've also heard over the radio that illegal immigration is actually at the lowest levels ever seen. And so I'm not sure. George tells a different story. So what's the risk of the data being manipulated?
Well, I mean, it's the data from the Department of Homeland Security. And, they would have been, if they were, going to support anything They would have had the numbers lower through the Biden administration because that was the Democrats in power, but the opposite happened. So I think the data is reasonably accurate. I don't have a problem with the data. I haven't found any kinks in that data historically. So this is the data that is produced by the Department of Homeland Security. So, like I don't believe that there is a problem with the data. I usually find US data to be pretty good, reasonably accurate. So I have no reason to doubt it. But, if somebody's got indications as to why this data would be untrue, I'd be happy to look at it.
All right, thanks for that, George. Let's go to conundrum 4.
Conundrum 4. Trump came in and probably the highest profile change that he wanted to make was that he was going to implement tariffs. He was going to apply tariffs to all sorts of imports into America, primarily with the objective of promoting domestic trade. But here's the thing about trade deficits. People think that you can manipulate trade deficits by simply changing the price of a good. And I'm here to tell you that the data doesn't bear that out. So let me give you a crude example. If you're a company and you are expanding and you are creating a new division and you need 10 more members of staff, those 10 members of staff need laptops. Whether that laptop costs 10% more than it did yesterday or 20% more than it did yesterday is not necessarily going to stop you buying those laptops. If you perceive there to be an opportunity, you are going to buy those laptops. In other words, demand trumps price often. And so you've got to focus on what that demand looks like. In America, the credit cycle has been extremely strong. So strong, in fact, that the demand for imports has far exceeded the demand for exports. That hasn't been a factor just related to price. It's been a factor of economic growth. It's been a factor of investment. It's been a factor of innovation. It's been a factor of capital investment from abroad into America. It's all of these things combined have resulted in tremendous domestic demand, and you can see that demand even for now outpacing that of many other developed market economies in the world. So demand in America has been strong. What's driven that very strong demand has been a combination of a very loose fiscal policy. In other words, the government has borrowed aggressively to spend in the economy, and relatively low interest rates for a prolonged period of time. On top of that, the Fed has conducted quantitative easing. So it has stimulated in every which way possible, and that has resulted in a strong credit cycle. Private consumption expenditure is one of the tools that we utilize to see just how strong that domestic demand is. And that domestic demand has been so strong that when you look at the US trade balance, the deficit, as a percent of that private consumption expenditure, you see that the deficit doesn't look all that bad. In percentage terms relative to the PCE, it doesn't look that bad. The only way that might happen is if PCE is indeed as strong as I've said that it is. So in other words, if Trump wanted to rebalance his trade account, what he would need to do is just have a look at his own internals and potentially consider the possibility that he had stimulated too hard. And that the trade deficit exploded because there was so much stimulus applied that the productive capacity of the US couldn't cope with the internal demand for goods and services that were required. That's just a fact of life. That's what's happened in America. In terms of some context, I pulled out what the tariff impositions looked like on manufactured products when Trump was during his first term in office, and you can see that little spike that happened for tariffs. But have a look at where tariffs have come. So they've come off a long way. There was a little spike up whilst Trump was in power, but it quickly got reversed when Biden came back into power, and so it amounted to very little. We can't read too much into the data that we have because those tariffs weren't around long enough to do any significant damage. However, we don't believe that Trump wants to utilize these tariffs necessarily just to impose them blanket on all goods. We believe that they're going to use them quite strategically. And we think that the example that you gave, Vichard, of Colombia through the course of this past week is a case in point. He indicated that he was going to slap them with sanctions and 25% tariffs on all goods exported from Colombia into the US. And they quickly turned around their policies on illegal immigrants and took them back. I think he's going to use tariffs as a negotiating tool primarily. He's going to try where he can to utilize them to collect more taxes, but the taxes that he's going to collect are they pale in comparison to the kind of tax breaks that he was talking about giving. So I don't believe tariffs are going to be the silver bullet that resolves America's problems. It's not going to rebalance the trade deficit. It's equally not going to collect the amount of taxes needed to plug the fiscal hole that he would create through tax revenues. It's not going to resolve all of America's innovation and manufacturing issues at all. There is stiff competition that's happening from elsewhere in the world. And so as a result of all of that, you do have to question whether or not proceeding with tariffs in the way that he has indicated that he would is going to have either the desired effect or any meaningful effect at all. So recall that in the same way that the tariffs were rescinded when Biden came in, Trump only has one term in office. It's going to take him a while to implement these tariffs in any event. So, should they get implemented through the course of a year or two, you'll have them around for a year or two before they, if we get a different government coming in after that, they could remove them altogether. And so, I think this whole issue of tariffs should be looked at as a negotiating tool rather than anything else, and that the real problems lie with domestic demand potentially being boosted far beyond the capabilities of America to satisfy that demand, as well as the fiscal constraints. So if we move on to the next slide, and we head back to what this ultimately means for America, well, there's a lot of uncertainty as to how this is all going to play out. None of the charts that I've showed you right now gives you any clear indication that that's all positive news for America. On the fiscal front, if they do cut taxes, that's great, but they're going to have to balance that off with slashing government expenditure somewhere, which is going to offset that to some degree, or they're going to have interest rates that do that for them because those bond yields are going to rise even higher. On the migration side of things, as I've indicated, that doesn't necessarily equal positive growth. Neither does it on the military spend and resolving all of those wars. So there's still quite a lot of uncertainty as to whether Trump is net positive for America or not. He does want to deregulate. I give that a tick. He does want to shrink the size of government. I give that a tick. He does want to cut taxes. I give that a tick. But there are consequences that he faces when doing all of these things. And there are offsets that are going to make those decisions a little more difficult to implement. It's not always as easy as Trump makes it sound when he speaks. Moving on, Richard. So through the course of the past week, we also had a little bit of a wake-up call, and one of those wake-up calls came in the form of a little market wobble. I'm not going to call it anything more than a wobble because that's what it turned out to be. That market wobble, I think, is long overdue. If one has a look at the stock market valuations in the US, they've been trading on a tremendous amount of good news. The latest spike up in equity markets has been the Trump trade, if you want to call it that. A lot of optimism about what Trump is going to achieve. But when you have a look at the valuations relative to their long-term means, and that's no matter what fundamental stock market indicators you look at, whether it's Buffett's, Husband's, or Tobin's, in all three cases, they are trading well above their historical means. So the orange line equates to the horizontal orange line, the horizontal orange line being the long-term mean, the same for the black, the same for the blue. In all three cases, well above the historical means. We think that it's been driven primarily by very expansive policies, the use of excess savings that were created, literally created out of thin air during COVID, the expansionary fiscal stance as they run budget deficits of 6.5%, the military stimulus that they had, and the COVID stimulus unwind that continues to unfold. So all of that boosted the stock markets to these sorts of levels. Now, you look at that and you think to yourself, okay, well, that's a little bit nerve-wracking, because you know that when these indicators deviate too far from the mean, that it does bake in some sense of vulnerability to these stock markets. And as a result of that, we need to be cautious, because there's an asymmetry in the risk profile of these markets. From these very overstretched markets, how much, what is the likelihood that they push significantly higher versus correct back down again for any possible reason? And lo and behold, this week we had a sign of what could be in the pipeline, given the situation in the US. So if you move on to the next slide, Vichard. It gives you a sense of just how far we've had these big moves in some of these big stocks. So NVIDIA, being the biggest move of all, has amassed something like $2 trillion through the course of the past year in market capitalization. That's what it did. All of a sudden, you get a I see there's a question here. Will DeepSeek and threat from China have any meaningful impact on stock valuations, particularly on US and global tech stocks? Or is this a red herring? Philip, I don't think it's a red herring. I don't think it's a red herring at all. I think it was a big wake-up call. I don't know that it's the death knell to tech in America for one simple reason. DeepSeek is open source, so everyone's got that technology now, including the likes of ChatGPT, OpenAI, and etc., have now got a new basis on which to compete. What it did, however, do is show that the American tech sector isn't quite as almighty as people thought that it was. It's not standout, and it's not the unicorn that everybody was positioning for. NVIDIA tech, their chips are the most powerful in the world, but China just showed that you don't need these uber powerful chips to be able to achieve a result that's even better than they had using these uber powerful chips. So I think it's causing a rebalance and at the very least a rethink into a lot of these chip makers, as well as the tech stocks that have geared themselves around AI and have pumped a tremendous amount of money into innovation around AI and the utilization of these chips. I remember an interview between I think it was Larry Ellison from Oracle. It was Elon Musk, and I think there was Zuckerberg, and they were having a discussion with the CEO of NVIDIA. And Jensen Chang, and they were effectively begging him to speed up the process of chip creation. Well, that's where NVIDIA's stock went and surged, is when this incessant demand for their very powerful chips just seemed to be growing and growing and growing. And China's just come along and shown that, well, they were able to do even better with far less powerful chips at a fraction of the price. So it has thrown things into disarray, but it is open source. So everybody's now got access to that technology, and you can still apply that same technology to NVIDIA's chips and get potentially an even better result. So I don't think it's a red herring. There has been a correction in those tech stocks, and I think that's probably correct. But we think that there's maybe a deeper issue here. And if you roll forward to the next slide, Becard, is we think it relates to something more fundamental than all of this. What we have noticed, and we've done some studies on this, what we have noticed is that stock markets, along with many other asset markets around the world, prices tend to rise when there is a lot of liquidity in the system. When central banks pump awful amounts, and we're talking about trillions upon trillions of dollars into the market, just as they did during COVID, where they pumped in something in the order of about $12 trillion into the global system in the space of just 18 months. That's when that red line went vertical at the start of 2020 there. That was that period of liquidity being pumped into the system. Well, have a look at what that liquidity is doing now. It's come right back down again. That plentiful liquidity environment that existed during COVID and through this period of exuberance when we've had all these stock markets running as hard as they have, that liquidity environment now appears to be drying up. And this is only as of November. Quantitative tightening is still continuing, both in America and across many other central banks in the world. And so we think that red line has further to drop. Now, I'm not saying that as a result of this red line, we can tell you when there's going to be another crash. What I am telling you is that this red line tells us when we are entering into a phase where some sort of a catalyst can come along, like a deep seek, and upend an entire market in a very short space of time because it was far too dependent on plentiful liquidity. The valuations are simply unjustifiably high, and this exuberance had continued for far too long. The deviations away from any fair value are just so extreme that the asymmetry in the risk profile becomes too high and stock markets correct. This particular chart has picked almost every crisis with remarkable accuracy, the troughs. So the fact that we are heading towards another trough and we're quite far advanced in that move, I think is something we should all be paying attention to. It's a very long-term chart. So, we could drop for another year to 18 months, 2 years on this chart before that crash happens. But I think this was the canary down the coal mine. This deep seek gave us a sense of just how susceptible and vulnerable stock markets can be should there be a little bit of disruptive news that comes out that was never seen or thought possible. So it's a black swan type event, but in this particular case, it was a small one. I don't think it's going to be fundamental to everything, but it was something that we need to pay attention to. So if we move forward, the interest rate environment as a result of all of this, I think, is down, but and you can see that in the table on the right. That green column effectively shows you all the central banks around the world that have been cutting. The chart on the left is your 3 major central banks that have been reducing interest rates. But aside from the ECB, the Fed and the BOE have flattened their trajectory, so they're not looking to cut anywhere near as much. There's resilience there. In terms of their economies, well, certainly in the case of the US, that's true. In the UK, they've got an inflation issue that they're still trying to get properly on top of. And so they've moderated those rate cut expectations, but rate cuts are still, I think, the play of the day. I don't know that the Fed cuts today. The market anticipates that South Africa will cut on Thursday, but we'll touch on that in a bit. But with all of that, I think this is supportive for growth. The question is whether or not this is supportive for the dollar. Once again, the dollar has surprised in its strength, and here I've had to come around to the notion that the US enjoys this exorbitant privilege as having the dollar as their reserve currency. That reserve currency allows them to do things that most other central banks can't do and get away with it, like run huge budget deficits, like conduct quantitative easing at will, etc., etc. So even when things turn pear-shaped, people still land up rotating to the dollar because the dollar is a reserve currency. There is no other competition to it. The Fed can do things to contain a big fallout in the way that many other central banks can't. And so the dollar, through times of uncertainty, remains buoyant. This latest pickup more recently is a case in point. Ahead of Trump, given this recent volatility, the dollar looked really strong again. But here we are in very dollar overvalued territory. And you've got to ask yourself whether or not this is sustainable. If you move on to the next chart, Richard.
George, just before we go on, I've got another question I'm going to show you on the screen. So
for markets to revert to mean? Which of Trump's dilemmas will most likely be a trigger for that? It's a really good question, Sebastian. If I had to hazard a guess, I would probably say it's going to be a combination of trade wars if they do erupt. I don't think they will, but if they do erupt, trade wars could be one. The other could be fiscal. How they contain fiscal is going to be really, really interesting. He wants to cut taxes, but you're running a budget deficit of 6.5%. So how do you offset that? And that offset is going to be the thing that no one really understands at this point. That could be a surprise which markets don't like. So on one hand, you cut taxes, great, but if you're slashing the size of government to offset that, what's the negative impact on growth of that? Now, I'm not saying I like big governments. I'm all for small governments and slashing the size of governments, but the initial impact of doing so is growth negative. Now, you're doing all of this at the tail end of a business cycle. So you are more vulnerable to a sell-off. Just remember that the unemployment rate has now started to tick up. It's rising again. So we're at the tail end of this business cycle. So Trump's got to tread really, really carefully here. And the solution isn't always just to chuck the Fed at the problem and loosen monetary policy and print up more money. It really is to fix the fiscal stuff. And so fiscal is another, I think, important one, Sebastian, in answer to your question. Getting back to the dollar, so the one thing that we have picked up is this very interesting deviation between what's happening to the dollar and what's happening to the gold price. We used to have this fairly strong relationship between the two. And bear in mind that the dollar is sitting on an inverse on an inverse scale because these two move inversely. So you would tend to find when the gold price rises, the dollar is weakening and vice versa. What's happening this time around is that we've got a dollar that is strengthening. That's the blue line going down. Remember, it's on an inverse scale. And you've got the gold price shooting higher, which is the black line. Now, you've got to question, how far does this relationship continue to stretch before it snaps? And if it snaps, is it the gold price that's going to retreat back down, or is it the dollar that's going to retreat back down? One of the two is going to snap at some point. But there's some interesting dynamics that are unfolding in the background, and herein lies some very interesting developments. What we have noticed recently is that whenever the dollar has started to surge, other countries around the world have wanted to protect their currencies. And so what they've done is sold US treasuries in order to do so. China's been one of those countries that has done so. And through the course of time, they have reduced their holdings of US treasuries almost by half. Not quite, but approaching. So they're down to 750 billions worth of treasury holdings when they used to hold around 1.3 trillion. At the same time, they've been selling US treasuries, they've been buying gold. So now the one, they've been, in other words, trying to contain the strength of the dollar whilst at the same time boosting the gold price, which is part and parcel of what we're seeing right now. China doesn't appear to be keen to hold US treasuries to the extent that they did anymore. They believe that they are simply supporting the dollar, and they're trying to they don't want to be supporters of the dollar any longer. There is talk of a BRICS currency that they want to bring out. It's not going to be country related so much as I think it's going to be backed by a combination of oil and gold. So if it's a digital currency backed by oil and gold, it would give you some perspective as to why the likes of India and China are buying gold and why BRICS went and included so many oil producers in the BRICS Plus, which now include Russia, Saudi, UAE, as well as Iran. So there's something afoot here, which I think we need to be aware of. Trump has come out and said he will take on any country that tries to undermine the strength of the dollar, but he's going to have a tough time if that digital currency is simply backed by gold and oil, not necessarily a specific country. especially if that starts to gain traction and undermines the dollar, you'll find some interesting dynamics unfolding there. Then finishing off, looking at the local focus, some green shoots arising at the moment. We don't like to look at GDP, so what we do is we've created a short-term cyclical indicator, which is the green line, the longer-term structural indicator, which is the black. The short-term indicator tends to look at things like interest rates, at money supply, the credit cycle, leading indicators, those sorts of things that give us a sense of how economic activity is likely to pan out over the next 12 to 18 months. The longer-term black one looks at things like savings, fixed investment, infrastructure, etc. in the economy. And there we're still trading in very adverse conditions. But the good news is both have turned up. And if that green line is able to remain above the zero and in buoyant or favorable territory going forward, it's likely to help drag that black line higher into less adverse and less challenging environments. So at the moment, the cyclical factors that we're seeing in South Africa are looking a lot more positive. We think that 2025 and 2026 are going to look much better than we've seen in 23 and 24. Whether or not that black line rises or not depends on the kind of reforms that are implemented by the GNU. And so we're looking forward to the budget coming out in Feb. If you move on, Vechard, to the next one. Fiscal remains the biggest problem for South Africa at the moment, but even on that front, there's been some improvement, and so the budget deficit, the latest budget deficit numbers have shrunk, have shown signs of shrinking, and I was pleasantly surprised to see the comments from our finance minister at Davos, where he indicated that the government was going to look at trying to get back into investment grade. And he thought it was possible to do within 2 years. Now, that might just be political rhetoric, and it's difficult to take things too seriously. But we have seen some positive signs that they are more serious about inclusion of the private sector in these reforms. And if they do so, I think that becomes a realistic prospect. So, in other words, take electricity, for example. If you have a look at the makeup of electricity production now, about 15 to 16 gigawatts is currently being produced by Eskom. About 6 to 7 gigawatts is now being produced by IPPs. Okay, so roughly half of what Eskom produces is now being produced by IPPs. So that takes us up to about 22, 23 gigawatts. And if you include solar panels on top of houses, you can add another 2.5 to 3 gigawatts of power. So, in other words, just liberating that sector to allow the private sector to play a role. We're now producing something in the order of 9 gigawatts of electricity. The private sector is relative to Eskom's 15 or 16. They're still the baseload power producers, but we have alleviated the pressure on Eskom substantially by allowing the private sector to play a role. The same could happen with the ports, the same could happen with the trains, and there are many other network industries that could also benefit from a greater private sector inclusion, on top of which we think that that inclusion of the private sector will play a significant role in boosting gross fixed capital formation, in other words, fixed investment into the South African economy. So there are very good reasons to be more optimistic. The list on the right is simply the challenges that government faces. But moving on to the next chart, Vechard, we do have clear signs that confidence measures are moving up. As you can see, they're not yet at that zero bound or above the 50, but we're getting there. And that's a step in the right direction. And I'm hoping the upcoming budget does a little bit more for that. And if we move on, Vechard, the results of all of this, because we're looking at a stronger economy, more generally speaking, and because the Fed has obviously toned down its expectations on rate cuts, we no longer are anticipating the South African Reserve Bank to cut as aggressively. So we think that there's a rate cut. If you had to have asked me, I would have said March. I would have favored was a better time to cut than than tomorrow. But the market appears to disagree with me. The market believes that tomorrow is a better time. And as a result of that, if tomorrow is a cut, I think it might be the last cut for the year. If we do get another cut this year, it will be quite late in the year.
George, isn't the market expecting us to cut tomorrow because the Fed cut in December and the SARB didn't have a meeting in December? And just to put us on even Stevens with the Fed again, the market is expecting Kanye to cut tomorrow. Although I'm still also on the same boat as you. I think it can be a 50-50.
Yeah, I mean that's the logic that is applied at the moment. That's what those that have penciled a cut tomorrow in are saying. That's the one argument. The other argument is that inflation is right down near the lower end of the inflation target range. Therefore, why not cut? Well, I'll tell you why not cut. And we got a taste of it earlier this week. The potential for volatility is high. You do one or two missteps and all of a sudden reducing interest rates and encouraging negative speculation on the rand is never a really good idea, not for South Africa. We also know that the dip in inflation might very well be temporary. And so a little bit of caution and a little bit of patience, I think, would go a long way, especially as if we waited until March, we would have some insight into what the government is going to be doing on the fiscal front. We'll also have a far better picture of what Trump's policies are going to look like by then, on top of which we'll have the guidance and the effects of that guidance of the Federal Reserve and one or two other central banks too. So, I just felt that 25 basis points at the end of the day could have waited another couple of months. It's not a very popular view. Like I said, the market thinks differently, but, I'm just putting it out there. If they don't cut tomorrow, don't be too surprised. The other factor that I also keep mentioning is that the Reserve Bank has been pushing for the Department of Finance to lower the inflation target. They want that inflation target down to 3%. Well, we're hovering around 3% now. So in the event that were to be an objective that could materialize sometime this year, you would probably favor keeping interest rates where they are right now to try and protect inflation and make sure that it doesn't jump higher, rather than just cutting for the sake of keeping up with the Joneses, so to speak. Nevertheless, the Reserve Bank has been amongst the more conservative of these central banks. The GNU has helped a lot in terms of boosting confidence, and so the rand has been one of the best performing currencies so far this year. It's only Peru that is level pegging with South Africa at the moment with the rand. So South Africa is still performing quite well, even though the recent sell-off has caused a stir domestically. The fact of the matter is that it's still performing quite well and better than a lot of other currencies, emerging market currencies that we have. When one has a look at our valuation chart to give us a sense of what would be the best strategy to adopt right now, well, we're very clearly back in exporter-friendly zone. So at these sorts of levels, we would encourage exporters to lock in prices a year from now. So this is a 12-month forward-looking perspective, and it's telling us that the probability is reasonably good that if you had to lock in some forward contract now, that you would beat spot a year from now. Supporting that to some degree is our Rand sentiment indicator, which interestingly has popped back up into positive territory. It's telling us that the options market is positioned for Rand to potentially strengthen a little bit further through the course of the next few months. It doesn't always hold true. This isn't a 1-for-1 ratio, but there is a reasonable correlation between our Rand sentiment indicator, which is that sort of bluey, green, turquoise line, and the black line. So it's telling us that Rand still has a little bit of life left in it once we get over a little blip that we're in right now. a lot of that might spring up off of a good budget. So if we get a good budget, and that's coming up in a month's time, there's every possibility that South Africa could attract some interest from abroad and attract capital. Recall that the authorities are also looking at removing South Africa from the grey list around the middle of this year. And if we do start to include the private sector and the reforms look tangible and meaningful, that these markets are going to front run reality. So that could be a little bit of good news that arises through the course of the next few months.
I've got two other questions on the currency that relates to one to the AGOA agreement, which says what will be the impact of the US withdrawal of AGOA later in the year, if it's going to happen. We're not sure. And then secondly, the other question is what is happening with foreign currency flows in the first week of the Trump presidency and President Ramaphosa signing the expropriation without compensation. Will that put the GNU under pressure?
Yeah. So those are interesting. Questions. Look, let me deal with AGOA first. Look, we know that AGOA is still in place until much later this year. I think it was September, October this year. So it's not going to affect us directly this year. Probably affect us a lot more next year if it gets withdrawn. There are some sectors that would obviously be affected a little bit more than others. Now, on that front, you will have noticed that our authorities have cozied up to the BRICS countries, and they've done so somewhat strategically. Part of the reason behind it is to reduce some of the exposure towards some of these Western countries and notably America. They've wanted to expose themselves to countries with higher growth rates. That doesn't mean to say that AGOA doesn't matter. It does matter. Of course, it matters. And it will be an impact. But in our calculations on what the effect will be, it tends to impact at the margin. It is not a wholesale black and white 1 and 0 type of scenario. It will impact demand for our goods if they're suddenly being sold at higher prices into those markets, and maybe it just won't be viable to do so any longer. That would be a pity, and it would detract from GDP growth at the margin. But we're talking about relatively small percentages as a percentage of the whole, of GDP as a whole. It depends what industry you're in, though. If you're in auto or agri, you might be affected proportionately more. So it is a little bit on a case-by-case basis that you have to look at that and try and find ways to mitigate that. But you've been warned. Trump is going in and he is reforming and he is changing. The chances are unfortunately high that AGOA is going to be at risk. South Africa hasn't exactly endeared itself to America with its stance on Israel and Russia. And so, this is where the chickens can come home to roost. I hope they don't. There is a flip side to that, in that America still wants to have a presence in Africa and on the African continent. They do still see South Africa as somewhat of a gateway into sub-Saharan Africa. And so as a result of South Africa's role within the African Union and others, they do like to have a little bit of sway in the geopolitics of the continent. So it's not guaranteed that just because Trump's in, he will exit, but the risk is there. It's certainly there. He's going to question whether or not AGOA is in the best interests of America. Again, this is where South Africa maybe hasn't helped itself in its geopolitical stance on those issues. So that's AGOA. Like I said, I don't think it's an insurmountable challenge. It is potentially a bloody nose, but it's not. It's as a percentage of the whole, it's manageable. On the issue of Trump flows in the market, we haven't seen any significant evidence of big outflows or inflows or anything of that nature. Vichard, you'd be better placed to answer that sort of thing. You're closer to that market than we are. But in terms of expropriation without compensation, we've got to realize that a lot of this has already gone through the Council of Provinces. It already got cleared. Ramaphosa, in fact, was constitutionally required to sign this off, and that was long before, and that happened long before the GNU. So the damage of this expropriation without compensation, this isn't something that Ramaphosa has just done now to be belligerent within the GNU. He's constitutionally required to sign it off because it's been through the processes already. It now landed on his desk almost like as a seal of approval, rubber stamp. He's constitutionally required to do that because of the process that it's gone through. Now, you look at it, the optics don't look good. I know that the agri-industry, for example, is concerned about the interpretation of that clause 25 and how that could be manipulated, not necessarily by this government, but by a future government that might be, more belligerent, whatever that looks like. Essentially, not a whole lot changed within that clause, other than what they did was take what was implicit in clause 25 and made it a little more explicit. So that's what's changed so far. Whether it actually generates a strong political reaction in terms of they actually get their act together to expropriate without compensation, I for one don't believe that's necessarily going to be the case. So I'm not trying to play it down. It's something that we should be vigilant about and hold these guys to account. But I don't think that that's going to be the undoing of the GNU. John Steenhuisen, unfortunately, he likes to play to the sort of the political spectacle, if you like. He likes to raise these issues, but he will know full well that Ramaphosa was obliged to sign that off. It wasn't to try and undermine the GNU. He was required to do so. Perhaps more of an issue when it comes to policy was the way that Ramaphosa has been dealing with the NHI. But on that front, I also don't think it's going to be the undoing of the GNU, for the simple reason that so much of civil society is going to tie that NHI up, or tie government up in legal knots, the likes of which is going to take them years and years and years to get out of. So I don't think that the launch of an NHI in any particular form or shape or form is going to happen anytime soon. I think they've got a long legal road to go through. And even when they do go through that legal road, you'll probably find that the NHI will be forced to change as a result of some of those legal findings. So therein, I think the DA has chosen to pick its fights. It knows that that wasting time and energy on the NHI when so much of the civil society is going to take that fight on, I think is it probably gives you a sense of my feelings on the political landscape as it stands.
Yeah, just so on the flow side, Philip, we haven't really seen anything much happening. It's just been very volatile. And the rand's been used as a proxy. Sometimes Brazil and some of the South American Latin countries is a little bit illiquid. So we've seen some comments like the real money flow oaks. They just use the rand as a proxy at the moment because there's a little bit of better liquidity. And especially, you must remember the East, especially China, Japan, all of those countries currently has got New Year's and long celebration. So there's a little bit of lack of liquidity out of the East as well. So that's why we've seen these big moves in the local currency. But George, I think we need to wrap it up here. We almost at time. Just as a last question, fair assumption to think that the rand sort of stable. I know we're above the range I'm going to call now, but for the next 6 months or so, the rand comfortably in a 1750 to 1850 type of range with brief breakouts both sides.
Yeah, I'd maybe lift that range a little bit. I'd probably make it, more like a 1780 to 19 type range. I think that's probably a fair call. I think we're near the top of the range at this stage of the game. But, it does require the authorities to come up with a decent budget that we can believe in. It's going to require the Reserve Bank to retain some measure of conservatism. So if we get the combination of a good budget, sharp conservatism, decent reforms, I think Rand can have a reasonable year this year. I say that knowing full well that the potential for some financial market volatility is always there. But barring that big bout of financial market volatility, I think Rand can do reasonably okay. I think it will hold its own. At the very least, I don't think it's going to be a huge inflation contributor, which means that interest rates can potentially come down a little bit further through the course of the next 2 years.
Thanks for that, George. And then just for everybody listening, we will be back and you'll get your invite to inbox soon where George and ourselves and our panel will look at what's happening with the budget and unpack the budget. That will be, we haven't got a formal date, but that will be around 19 or the 20th of Feb this year. So look out for the invite and we look forward to talking to all of you then. Until then, enjoy the rest of your day and week. Cheers, everybody.
Thanks, everyone.